Now, today's class is brought to you by Alvexo, one of the world's leading brokers for forex and CFD trading. With Alvexo, a real broker for real traders, you can trade stocks, indices, forex, commodities, and cryptocurrencies. If you want, during our webinar today, you can go to www.alvexo and open a demo account and use their charts to follow along as we go through moving averages. As you can see on your screen, the Alvexo site is easy. Easy on the eyes, easy on the mind, easy on customization, easy on trading. Everything you need can be personalized and customized to fit your style. And you can use their incredible web trader, or you can download the MT4 terminal or use the mobile device. And you can trade across all your devices at any time in any way that you see fit. And as you can see on the screen, everything with Alvexo is easy, plain and simple. They offer forex trading, indices, commodities, shares, and cryptocurrencies. Now, you get cutting-edge technology, you get award-winning customer service, and you get to trade with a regulated broker. Now, today's class is being recorded. And if you wish to see a recorded version of today's class, you can do so by using the same link used to come to this live class in about 24 hours, and you'll see a copy of the actual recording of this class. Now, please remember, Alvexo is a regulated broker. So keep in mind, trading carries risks. Make sure you understand them, and remember, your capital is at risk. Now, because Alvexo is a regulated provider, I've got to give you a risk warning. Now, I'm going to read the first sentence, and I would appreciate it greatly if you could read what's on your screen. Trading forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. This webinar is considered a marketing communication and does not contain and should not be construed as containing investment advice or an investment recommendation. Now, in today's class, I'm going to provide you personal opinions and experiences. Now, I've been trading since the 1970s. Yeah, I'm that old. And believe me, there is nothing in the world that's a super secret sauce. Education, experience, risk management, more education, more experience, and more risk management is what trading is all about. Understanding what you do and what your decisions are is critically important. Yeah, you can listen to gurus, you can read all kinds of reports, you can listen to the news, but ultimately you should only be trading based on your own decision and your own understanding. And remember, your capital is at risk. Now, in today's class, I'm going to use the term security, but I'm referring to actually all tradable assets that are in the open market. So I'm probably going to say the euro. In fact, I know I will. I might say Facebook. I'm probably going to mention Bitcoin since it broke 50,000 today. Whoa, is that a shocker? Similarly, I intermix the terms investing and trading. Typically, an investor takes a long-term position while a trader takes a much shorter-term position. In either case, the basic concepts and techniques are the same. Now, ultimately, people always ask me, no matter where I go, it seems that they just think that anybody and everybody can advise them. So they're always asking, what should I buy today? What should I sell today? I can't tell you over the weekend how many emails and how many text messages, how many WhatsApp messages I got about, should I buy a Bitcoin? Should I sell my Bitcoin? Well, the fact is, I watch Bitcoin generally, but I don't trade it. So I have no real recommendation, but they all want me to tell them. They want to know what prices will be tomorrow, what they'll be next week or next year. Wouldn't investing be easy if we knew the answers to these seemingly simple questions? Well, I don't have a crystal ball. I don't have a Ouija board, and neither does anybody else. So if you're attending this class in the hopes that technical analysis has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hopes that technical analysis will improve your investing and trading and make you a smarter trader so that you make better decisions, that it surely will. Now, moving averages are one of the oldest indicators and one of the most used indicators. Moving averages make the basis for a lot of indicators like MACD, moving average convergence and divergence, uses moving averages. So does Bollinger Bands. The center line for a Bollinger Band is a moving average. Most or a great deal of the indicators we use in the market are formulated based off of some type of an average. Now, a simple moving average, which is called an SMA, is really simplistic. But what it does, it helps us interpret price fluctuations because it smooths out random movements and takes the noise out of markets. Now, technical analysts have harnessed a wide range of indicators over time, but the moving average stands out due to it being simple, practical, and useful. By using it, forex traders can identify price trends as well as support and resistance levels and a lot more. Now, every one of you sitting out there in the audience today knows about a simple moving average. You're saying, why am I spending my time in a class learning about a simple moving average? Well, I agree with you because a simple moving average is number one, what we call a lagging indicator. A lagging indicator means that it lags behind price movement because it needs that last close to calculate what the value is before it can put it on your charts. And a simple moving average is really simple. If we're using a 10-period or a 10-day moving average, say we're looking at a 1-hour chart, and we're looking at a 10-period moving average, we would take on a standard level, we would take the close of the last 10 candles, add them together, divide it by 10. Okay. And that would give us a moving average. That's really simplistic. And it really doesn't give us much information because if the price sailed up in the last time frame, or the last 2 time frames, or skyrocketed 3 time frames ago and then fell back down, it doesn't take that into account because it's averaging the close over the last 10 periods. So it doesn't take the most recent movements and give it enough weight. So to make a moving average less lagging and to make it more sensitive to the most recent prices, mathematicians and statisticians have developed what we call the exponential moving average. And today, the EMA, the exponential moving average, is used a lot more than an SMA. Now, before we go on, let's go over to a live chart so we can see this, because I know it gets very boring just letting me talk about it. Okay, so right now we're looking at my standard teaching chart. This is the Euro US dollar 1-hour chart. Okay, nothing complicated. We're looking at the candles. We see the euro is a nice steady upward movement, nice little uptrend, and it's trading right now at somewhere around the 121 range, 121.6. And now we see the blue line is I don't want to use that. It's a 12-period EMA. Let's go ahead. Let's turn that one off. And we're going to use a 20-period moving average. That's the blue line I just dropped on your screen. Let me make it a little bit bolder so you can see a little bit better. Okay, so that blue line is a 20-period moving average. Very simplistic. And we can see it didn't have much reaction, even though the euro jumped up here just in the most recent. It's moved up somewhat, but it hasn't reacted that drastically to these price movements. Now, we have some basic understanding on a moving average. We can call it red light, green light. You would only consider an uptrend, a buy or a long trade when prices are above the moving average. When prices below the moving average, you would only consider a short trade. And that's called red light green. That will always keep you trading on the side of the price movement. Now, like I said, a 20 period moving average is a standard moving average, but a simple moving average doesn't help us all that much, except what we just talked about. And we could use it for levels of support and resistance. Now, as I said, a lot of traders have switched over to EMAs, which is the gold line I just put on your chart. And that's the same moving average as a 20 period moving average, but it's using an EMA. An EMA is similar in calculation to a moving average, except there's a formula, and I'll show you what it is. It's very easy to calculate, but you don't have to. Everything just does it all. That gives more weight to the most recent closes. And you could see how the gold line here, the EMA, is slightly above the blue line, or more accurate than the blue simple moving average. Now, these are the basics of a moving average. Not very complex, but when we look below, this is a MACD. A MACD has a MACD line, which is the value of a 12 period and a 26 period moving average subtracted from one another. Then we have a MACD trigger line, which is a 9 period moving average. So as I said, moving averages are used for many different calculations. So let's take this simple moving average off our chart. And we have an EMA. So let's go back and talk about how to calculate. And then we're going to go over and talk about other types of moving averages and moving average crossovers that are a little bit more complex and maybe things that you haven't thought about yet. So to give a simple moving average, the exponential moving average is giving more importance to the current price levels rather than the closing price of the candles that make the period. Between the SMA and the EMA is much more accurate as it doesn't lack that much. A moving average calculation is not mandatory on closing prices. Now, as I said earlier, I've been trading since the 1970s. Remember, in the 70s, we didn't have the internet. We didn't have computers, so to speak. I mean, we had rooms that had these great big computer rooms in them that they were really just big data processing machines. We did all of our charting and our calculations by hand. Okay. In those days, all moving averages were based on the close. And so it's standard to say, to calculate a moving average, take the close of the last 10 periods, add them together, and divide by 10. But today, things have gotten a little bit more complex. So when I go up here and put my moving average on a chart and do my settings, look at what it gives me. I can use the close, I can use the open, I can use the high, I can use the close. I can use the high low divided by 2. I can use the high low close divided by 3. I can use the open high low and close divided by 4. I can use it as an EMA. Okay, way too many choices. It doesn't give us a big enough variance, but there's always a guru out there trying to preach his own use. And today, our modern computers with modern charts and all of these advanced developers have really, as far as I see it, given us way too much choice. So I stick with the close for calculating my moving averages. Okay. But all of these advancements have also given us some new ways to use moving averages. So let's first talk about how to calculate the EMA. So calculating the EMA is a bit more complicated than a simple moving average. Believe me, you will never have to calculate it. But when you see how easy the calculation is, you'll be surprised. I could do that myself in a second. So to determine this moving average, a forex trader should begin by selecting the time period, for example, 10 days or 10 periods, and then calculate its SMA. So the first thing you start with is the simple moving average. Take the last 10 periods, add it together, divide it by 10. Now you have your SMA. Next, the investor should figure out the multiplier here you will use to give the most recent data points greater emphasis. The size of the multiplier will depend on how long the EMA is. Now, this is not a customizable decision. You've customized it by determining that you want to use a 10-period EMA or a 10-period moving average. So next, you would figure out the multiplier by taking the most recent data. It takes some advantage of the most recent data points. So to calculate the multiplier, you simply use this formula. The multiplier is equal to 2 divided by the number of time periods plus 1. So in other words, for a 10-day or 10-period EMA, we would use 2 divided by 10 plus 1, which will give us 0.18 or 18%. For a 20 period, we use 2 divided by 20 plus 1, which gives us a 9.52%. That's it. So you don't even have to calculate, you can put them in your pocket. But if you're using a 26 period EMA or a 50-day EMA or a 29 period EMA, you would use the same calculation. Okay. 2 divided by 26 plus 1, and then come up with what it equals. Okay, so once you've got this multiplier, all you do is take the multiplier times the closing price minus the EMA for the previous day and add the current EMA value that you did with the calculation earlier. So an exponential weighted moving average puts more emphasis on the current price rather than simply averaging the price closes. It reduces the lag time by applying more weight to recent prices. While many don't grasp the difference between the two, there is one, and is significant. So we saw the difference that I showed you on the euro-US dollar between the simple moving average and the EMA. So if we're using a moving average crossover strategy, and a moving average crossover strategy is pretty simple. You select the two moving averages, one's faster and one's slower, whether you want to use a 10 and a 19, a 10 and a 21, they're standard ones. Okay, say you want to use a 30 and a 60. Okay, you plot those two moving averages using an EMA and you'll get a much better response with an EMA. And when they cross over, depending on which one crosses which in which direction, you're either getting a buy signal or a sell signal. We can even use a 3-period EMA, a 3-period moving average. Now, I just mentioned we might use a 10 and a 20, a 20 and a 30, a 30 and a 60. We'll go over the time periods that fit into our trading in a minute. But I also mentioned faster and slower. This is a concept that sometimes traders get confused by. That when somebody's talking about a faster moving average and a slower moving average. So I just want to get the terminology down with you. Whenever you are using multiple moving averages, the shortest period, the smallest time segment, is always the fastest moving average. Why? Well, if you were to use let's stick with simple moving average for a minute. But if you were using a 10-period simple moving average, you would be going back 10 time frames, adding the 10 together and dividing it by 10, and that's your moving average. It would respond a lot faster to shifts in price than if you're using a 30-period moving average and using the close of the last 30 periods, adding that together and dividing it by 30. Because the price was being steadily moving upward or dropped tremendously, that when you're dividing it, taking 30 movements and dividing it, it reacts a little bit slower. So if you were using a 10, a 30, and a 60, the 60 would then be the slowest. So you can have many slow and fast, but you have to understand the concept of the fast and the slow. Okay. So the fastest one is the shortest time period. It reacts faster. The slowest is going to be the longer time period. Now, there's many of us who use a combination of two, forget the moving average crossovers, but we look at the difference between the two when they're a divide, like say in this area, and we call this dead man zone. Okay. Now here it has to be an EMA and an SMA, but we would call the difference dead man zone, and we would never take a trade in dead man zone. Let's go back to the chart and I'll show it to you again on a live chart. Okay, so now we have two EMAs on a chart. We have a 10 and I don't want to use a 12. So let's, okay, so now we have a 20 period. Nope, sorry about that. I'd rather use a 10 and a 30. I'm just using ones that I'm comfortable with. Okay, so right now we're using a 10 and a 30. The 30 is the blue line. Let me write 30 on here for you. And the gold is the 10 period. So a lot of traders will say that when prices between these two moving averages, I won't take a trade. When it's above the gold moving average or the 10 period moving average, I would consider a buy. And only when it's below the longer period moving average would I consider a sell. Now, this is not from making decisions. This is a filter system. So it helps you filter out trades that might be awkward. Now, look at the difference between these two here. Because we had so much activity in the euro, we have the 10 period that was much more responsive to this shift, where the 30 period didn't respond as much to this big movement in this area. There are a lot of strategies that say here, when the moving averages cross each other, you get buy and sell signals. Okay. I don't use moving average crossover. They're a very simplistic way of making a trading decision, but a lot of people swear by them. So it's not that I'm telling you they're bad or good. It's just not part of my trading philosophy. Now, this leads us up to other types of moving averages. Now, you'll hear about them now and then. Most people don't use them that often because we use EMAs, but we also have volume weighted moving average. And it's a simple moving average that considers the volume traded during that period. Okay. Because they believe volume reflects supply and demand imbalances. Well, the fact is that works pretty well if you're trading stocks, okay? Or if you're trading stocks on the exchanges, or if you're trading commodities. Because if you're trading commodities or stocks, you're getting actual volume. You have to remember when you're trading CFDs, when you're trading forex, when you're trading cryptocurrencies, you're not getting all of the volume. Not anybody's trying to mislead you, but because they're not traded on centralized exchanges, what you're getting in your volume is in most cases the volume based on the liquidity provider who's providing you the information on that platform, the data feed. Because there is no centralized exchange that's tracking all of the volume globally. So a volume weighted moving average works in very restricted areas today, and most people don't use it. Then we come to one of the newest types of moving averages, and this is called a displaced moving average. A displaced moving average has become much easier to use because of our advanced charts. I've started using them a great deal, and I find that I'm really happy with the results that I get. Now, it's a new concept without any new calculation. So it's something that our new computerized charting systems allow us to do. So traders found that multiple time price is slicing through various SMAs like there's no support or resistance. Then we see price reacting from lower or higher levels. Okay. And like I said, an SMA is fairly inaccurate. Not inaccurate, it gives us some really relative basic information. And even an EMA gives us some weighted information, but it's still lagging because it's using the last time frame to do the calculation. So to overcome this, traders are cheating a bit. They're using the same MA formula for an SMA or an EMA, but they're shifting the outcome forward in time. Now, there's some people who talk about backwards. I don't understand why you go backwards. It's just something that today's charts allow you to do and take a negative time frame, but don't get tied up. The results, though, is fascinating when you shift your moving average forward. Important support and resistance areas result from the same moving average, meaning only that a small trick influences your outcome of your charts. So let me take you over to a live chart. Let me try to explain this concept to you. It's not mathematical. It's not very complex, except understanding it. So here I just took off the 10 period. Actually, let's keep the 10. Let's give it to 30. And so here we have our 10 period EMA on our chart. Okay, we understand what it is. Now I'm going to go change the blue line that we had before to be the same. So actually you don't see it right now because it's directly underneath, or you see the blue, not the gold, because one is overlaying the other. Now I'm going to take this one and I'm going to offset it by 3 time frames. Okay. Didn't change my calculation. If you notice, now the blue line is 3 time frames forward on my chart. The line itself has been shifted forward. It's still the same mathematical calculation, but it's moved our lagging EMA into a leading indicator that's in front of time. So we have it, I've only pushed it forward 3 time frames. Okay. And it's just a matter of where the system puts the dot on your computer to connect the line together. But by doing this, we get a leading indicator of what price might be doing, as well as a more accurate support and resistance line. Like I said, it didn't change any of the calculation. You could see the difference, and you can see how they mirror each other. There's nothing different in the calculation, but instead of being behind, it's now in front of the market. And a lot of us who have started using it have found that we're getting very positive results in our interpretation and our trading strategy by doing this. So now you see it as a new moving average, and you have, again, the red light, green light, and you have other interpretations, because now you can use it as a moving average crossover strategy with both of them being displaced three time frame. Now I'm only picking 3 because that's what I use. You can pick 5, 7, 1. But so now we got a much more accurate buy signal here while we're actually in the buy. We got it predicting the movement here. Okay, here we got a much more accurate sell signal, okay, because we've shifted it all forward. Now it sounds ridiculous, but it works extremely well. So it's an idea. Now, there isn't much on the internet about it yet. So you're not going to, there's some gurus pushing it all. It's something that you're going to have to get used to and practice. There's enough information, okay, and it's being used enough, but there isn't thousands and thousands of articles and examples. And yes, you'll find some guru telling you, change this to 10, I've seen them, change this to a -2 and add this one, make this one a +3. And when the two of them do this, do this. Don't. Use it in your standard calculations and see how it's improving your trading. Because just recently, I found a new way that we can use moving averages. And it's only because of the advantage of these of our charts. is now I can shift the indicator time frame. So even though I'm using a 1 hour chart, I could say calculate my moving average based on the 30-minute. So it also shifted my moving average. So what I'm saying is, because it used to be whatever chart you were looking at, the moving average is calculated on that. So if you're looking at a 1 hour chart, just using if you choose a 5 or 7 or 10, whatever moving average you're choosing, it's going to calculate that on the close of the last 10 time periods, or the last 7 or the last 4. But now what I'm saying is, I'm using a 1 hour chart, but calculate my moving average on a 10 1 hour using a 45-minute close. So, or a 30-minute close. So instead, it's going to calculate back the same distance, but use the close every half hour. And I haven't really tested this yet, but it's a new way of possibly using moving averages. It's an interesting way. But again, whenever you customize or personalize something, you have to test it. You have to add it into your trading system. You have to see what its results are and see how interesting it is. Because today, with the advancement of computers, we're getting a lot more ability to customize things that we didn't have that long ago. And we as retail traders were always a step behind, because we could only use charts that offered us these choices. We could only use platforms that offered us those choices. Today, we're getting offered more and more technology, and we have to learn how these can fit into our trading and advance our trading systems so that we can compete up there with the guys with the big black boxes and the big technical analysis, God knows, whole development sections of big investment houses. But now you've got these tools at your fingertips. But once a trader has calculated one or more moving averages for a security, he can use it in a wide range of purposes. Many investors utilize these indicators to determine what trend an asset is following. For example, a currency pair could follow an uptrend or a period of rising values during a time frame. Most investors seek to identify these trends and try to profit from them. Alternatively, a security may do the opposite and follow a downtrend over a period. When an investment behaves this way, it can create losses for any people or institutions owning it. However, investors should keep in mind that whether a security is rising or falling in value, there are many different ways that they generate returns from either its rise or its descent. For example, as long as the asset is climbing in value, investors can simply buy them and obtain a potential profit. They can also generate returns from depreciating securities through strategies like shorting. Now, it's worth noting that forex traders with different preferences may employ moving averages of varying length. For example, someone looking to invest over the longer term may look at how a security performs over a time frame of 20 trading days, as this will grant insight into how a financial instrument is performing in the long term. Alternatively, an individual focusing on short-term trading, like we do, might hone in on how to use a currency pair in a 20-period window, as well as providing a sense of how the pair performed in a comparatively short time. Now, if a forex trader can identify the momentum of a security, he can buy or sell that asset and even take out longer short-term positions. So a moving average will help us see short-term, long-term, and medium-term momentum. So for example, if a forex trader wanted to ascertain the short-term momentum of the euro-US dollar, he could look at a 20-period SMA or EMA. If he instead desires a better sense of the pair's long-term momentum, he might look at a 100-period moving average. One more benefit of moving averages is that they can be used to determine an asset's support and resistance. Securities will often find support at moving averages or resistance below moving averages. Many forex traders will expect securities to find support once they reach key averages and use other indicators in order to back up their forecasts. If an investor takes the time to master the moving average and the many benefits it provides, they will have access to a wide range of tools that would not be able to harness otherwise. With these implements, Forex traders can make better informed decisions and increase their chances of meeting their investment objectives. Now, in theory, there are an infinite number of simple moving averages. Now, if you're thinking that you will produce some weird 46 period SMA to beat the markets, let me stop you now. It's important to use the most common SMAs or EMAs, as they are the ones that traders will use to identify with. While I do advocate you not following everyone else, it is important to know what other traders are looking at for clues. It's important to know that everybody's using a 20 period moving average, and when price hits that, you're expecting it to break through or stay below, whichever it does. And at that point, you get a reaction where if you're using a 21.5 SMA with this and that combined, you're not seeing the market reactions. Now, a 5 period is what we call the hyper trader. The shorter the SMA or the shorter the moving average, the more signals you will get in receiving it. The best way to use a 5 period is as a trade trigger in conjunction with a longer period. 10 is about the most popular for short-term traders. It's great for swing traders and day traders. And then 20 is about the last stop on the bus for our short-term traders. Beyond 20, you're basically looking at more primary trends. Popular simple moving averages are also a 50 period. Now, some traders will try to tell you the simple moving average trading systems where you buy and sell if a price breaks the average on the closing basis. It was like the red light, green light I told you. Unfortunately, this is not accurate. Oftentimes, assets will take over or under a moving average to only continue in their primary direction. But now that I've given you just enough doubt before ever attempting to trade with a moving average, let's review a few things that you can make money. In the end, it comes down to what you are comfortable with. The EMA gives you more and earlier signals, but it also gives you more false and premature signals. The SMA is a little bit more simplistic and lags way behind in the market. Displaced moving averages are something very new, and multiple period moving averages are very new. But keep in mind that we have 9 or 10 periods are standard, 21, 20, and 20, and 50 for us, our type of traders. And here you can see on this chart where we've actually combined 3 different moving averages, and we've used them together. And we can see where the longer period moving average, we're using a 10, a 50, and a 21, and how they fan out, here how they cross each other, here where they come together. They can give you all types of information. But look down here where all 3 moving averages crossed each other. That is an extremely strong buy signal. Here we have the 50 period AML, which worked as support. So throughout the trends, price respected different moving averages as support. A break of the moving average is a significant signal. So remember, 20 and 21 period, 50 period, 100 period is way too long. 200 is the end of the bus stop. But now that you know the difference between the moving averages and how to choose the right period setting, we've looked at many different ways that we can use moving averages. And we can find how to ride the trends, how to exit trades, how to find trades. We can use them as trend directions and filter systems. And we can use them as moving average crossovers, or we can just use them as trend predictors. There's many ways that we can use moving averages in our everyday trading and to help improve our trading decisions and to filter out good trades and bad trades or potentially harmful trades. Now, do remember that moving averages don't change much during range trading. And keep in mind that a Bollinger Band, for instance, uses a basis of a 20 period SMA. Think about shifting that Bollinger Band to only a 20 period EMA or a 20 period displaced moving average and see how it changes the results and maybe more accurately gives you decisions. But there's lots of ways that we can include moving averages in our trading. So you can see that moving averages are a multifaceted trading tool that can be used in a variety of different ways. Once a trader understands the implications and how they work as a self-fulfilling prophecy and how to pick the right period settings, moving averages become an important tool in any trader's toolbox. So keep that in mind. Thank you very much for joining us. Look at those two new ways of using moving averages that I showed you and try to add moving averages into your everyday trading. And if you have any questions, go to www.alvexo.com and use our live chat button or arrange to talk to a financial analyst or go to their education center and someone will help you out. Believe me, that's what Alvexo is here for, to help you with all of your trading understandings and decisions. So have a great day now, and thank you for joining us today.